All right. Well, good morning, good afternoon, everyone. Thank you for joining us today at this webinar, Financing Energy Storage Projects, Challenges and Opportunities. My name is Christina Galan, and I will be moderating this session today. We have great experts in the field that will also be attending as speakers for our Red Mat event in Las Vegas in April on the 18th and 19th. And we're here for this panel specializing on financing, bankability. The landscape has changed a bit. So here we have tons of questions prepared, but feel free to ask any questions that you want to ask to our speakers. We will try to go through as many as we can. And also let us know where you're from, where you come from, your background, what you do, your job title. We want to know a lot about you. So you can also join into this webinar. This session will be recorded for everyone. We will share it with you in the following days. Also, hi to everyone who is connecting on YouTube. You also have a chat there to ask any questions that you want to ask or any comments. For the ones who are on Zoom, you have the chat to let us know where you're from. And you also have a specific section in questions and comments. If you have any questions, just let us know and we will help you. So without further ado, we were going to introduce our panelists of today, our speakers. They're going to tell us a little bit about them, where they come from, and if they want to share any facts, anything interesting that they would like to share with the industry before starting the questions, please go ahead. So Jose, we're going to start with you. Hi, Jose. Welcome.
Thank you, Christina, and thank you everybody else to being here. I'm José Tellechea. I'm an associate director at Mazars based in New York. I work mostly on consulting in renewable energy and battery storage projects. We do consulting around financial modeling. So we do financial models, we audit them, we train people, and we're seeing a lot of activity within the storage sector with the IRA and the incorporation of the ITC for the standalone projects. So again, appreciate the invite. I've been doing renewable energy projects over the last 12 years, storage maybe over the last 4. I had the opportunity to work with Andrew on the first standalone storage financing in the US a few years ago. And after that, I also participated in the first fully merchant battery storage financing at a project finance level. So again, thank you for being here and looking forward to the conversation today.
Awesome. Well, thank you, Jose. Only 12 years in the industry? Just kidding. All right. Thank you for being here. Kelly, welcome whenever you're ready. You're on mute.
Amateur problem. Kelly Sarber, nice to see everybody. Thank you for joining us. Really looking forward to this discussion, and I've got a really great panel of associates here that really understand the business. So everybody's getting a real advantage. I have been a developer for many, many years. I actually started in the solid waste recycling, wastewater, anaerobic digestion, waste energy business in my early career, and I pivoted to renewables about 10 years ago. I have the largest solar plus storage project that is in construction in the United States today at 3.2 gigawatts of PV plus 2 gigawatts of storage and a hydrogen hub in Western Arizona on a new transmission line that was developed by Starwood, now rebranded as Lotus. So that project's in development. And then I also have led the effort by one of my clients, Hanwha, in entering the New York City market, where we have a 100 megawatt project that's contracted currently with Con Edison and in late stages of development today, entering construction shortly. So I'm happy to be sharing some of my insights into how this business is changing, what are some of the challenges that are facing traditional developers like myself, and some of the secret sauces that may help you to overcome some of those challenges.
Great. Well, thank you, Kelly. I think the secret sauces are very much needed nowadays. So moving on to Ken Kramer. Hi, Ken. How are you?
Hi. Very nice to be here. Thank you. My name is Ken Kramer. I'm a partner in Rushton Atlantic, an appraisal firm that specializes in the energy space. We have been active in of late renewables. 25 years ago, it was probably more, coal and gas plant appraisals. And where we really fit into all this is providing the appraised fair market values that determine what the ITC and therefore the amounts eligible for tax equity investment are. And that's what I'll be talking about.
Perfect. Well, thank you very much, Ken, for being here. Last but certainly not least, we have Andrew Chen today. Hi, Andrew.
Hi, Christina, and hi, everyone. Good afternoon. Andrew Chen with CIT for Citizens Bank. Been on the power project finance side here for about 15 years. And prior to CIT for Citizens Bank, I worked at GE, EFS, BTMU, TD, and National Australia Bank in a similar capacity, financing power projects. And as Kelly and Ken and also Jose as well can attest, the financing of power and infrastructure projects really started early on with coal plants, in the late 90s, and then moved on to financing some initial merchant gas storage. Initial gas-fired financings in the early 2000s. And then we moved on to wind projects after that, and then finally to solar projects, as Kelly mentioned, the last 10 years, and more recently, probably within the last 5, battery storage projects. So I've been in the industry for over 20 years in the power project finance banking. I would say as a member of our CIT for Citizens energy team, we really do pride ourselves on being at the forefront of financing newer technology or newer areas in the energy space. As Jose had mentioned, we did one of the very early financings in California for standalone battery storage. And we also did a fully merchant battery storage financing. So I know Jose took credit for the first one, but we might have been right there with him. If not, we were 1 or 1.5 right there. So, and then I would say, just kind of backing up a little bit, early on, CIT did start financing, warehouse supply loans for wind turbines. And then as we moved on into solar financings, those were all done on with long-term PPA contracts. A lot of states had RPS standards that they had to satisfy. So as those RPSs got filled up fairly quickly, the contract terms started to shorten. And then we had to move into financing solar projects with merchant tails. And now, as we're looking at the evolution of that, the battery storage market started to make some noise due to a lot of the intermittency issues with solar and wind. And so, we also started to move into the financings of these contracted battery storage projects initially. And then subsequently, other banks also followed along, and we moved into fully merchant battery storage to kind of stay ahead. So now we are always looking to try and stay ahead of the market, and just enough to capitalize as an early mover, but not too much where the technology has not caught up with the financing. So that's kind of an overview of topics, or just a kind of history and topics that we're looking forward. So really looking forward here to having a productive webinar with the fellow panelists here, and we'll turn it back to you, Christina, for Q&A.
Thank you, Andrew. Thank you. It's really interesting. We're going to talk about merchant projects in a bit. So I think it's something that is really being talked and discussed lately. But first, we have, as I said, a couple of pre-submitted questions. In the meantime, feel free to let us know the questions that you might have in the Q&A box. Our panelists also can read them, but I will also select them and send them to one of our speakers. So we're going to start to kind of break the ice, kind of know a little bit about the challenges that the industry is facing, and how mainly companies or the industry are facing these. So Kelly, I'm going to start with you. If you could tell me, as a general idea, kind of to open up the panel, what are the main challenges as a developer you are experiencing right now? Oh, you're on mute.
That's the second time today. Sorry, everybody. All right, I will say I'm going to jump into this because there have been a lot of challenges that are really post-pandemic. I think the most serious one has been the supply chain issues and availability of equipment, as well as the cost of lithium ion. If you have a PPA or an ESSA that was contracted for prior to COVID, and you were in the development period, which typically on these batteries can be anything between 2 and 4 years, depending on the market you're in. That market development gap created a lot of risk exposure to price increases. We had a $35 million increase in price that was given to us from our battery supplier, even though we had a currently executed contract. So that has been really an issue of risk that the market wasn't prepared to deal with as from a developer standpoint. So where that's going is that a lot, and the reasons for that I think are pretty obvious. We have EV vehicles and very large companies vertically integrating backwards into the lithium ion chain, and they're tying up a lot of that product. Which means that if you're a medium-sized developer, you're going to be at a disadvantage in the future because a lot of the larger companies are buying into that lithium ion supply chain. So I would say that that's one issue. A second issue has been really sort of that a lot of these ISO markets are lacking revenue stacking. So in markets like California and Texas, very, very robust development. All of us are doing projects in those markets, and those are markets that are really evolving very quickly and have a lot of active development. Other markets like in New York and some other states are not as, while they're hot and everybody's incubating projects. I have 8 or 9 projects in the New York metro area around offshore wind, as well as just for the utility Con Edison, as well as NYSERDA. That market has been difficult because the wholesale rates from a merchant standpoint in that market without a off-taker are very difficult to finance these projects. And so what it is really advantaging companies that have merchant trading desks that have and are used to that risk versus traditional business models where you have contracted revenue streams over a period of time that can help you to hedge your capital investment. So some of these other markets are a little bit behind California, and we're really encouraging them to replicate some of the market structures in both Texas as well as California, probably more, to help these projects really get financed and put into place, because the states have massive goals. They want, like, for example, New York wants 6,000 megawatts of battery storage by 2030, and they probably have less than a couple hundred that are in place currently in that market. So for private companies to come in and invest, there needs to be a guaranteed way of getting these projects financed. And I'm talking specifically about lithium ion because we haven't seen a lot of long duration storage that have warranty wraps. The best that I've seen is ESS, which is a plug for some friends of mine, iron flow batteries that have been able to get a warranty and an EPC wrap so that they can replicate these commercial lithium ion projects. So I'll leave it at that. 2 things: lithium ion and the risks of that, those costs increasing and that risk being borne by the developer is one very large difference in how the business has changed. The prices then going up instead of down, like usually in solar, you had prices go down over that 2 or 3 year period. So you actually had a little more gravy in your pro forma. So that's a difference in the battery. And then sort of this merchant risk and the inability to have forecasts really line up and everybody agree to what those revenue stream opportunities look like after the project falls off a PPA.
Okay, great. Well, thank you, Kelly, for these insights. Andrew, from a different background, do you see similar challenges or do you have a different view?
I think from the financing side of things, the challenges are a bit kind of bifurcated. If you're talking about a fully contracted or even a quasi-contracted battery storage system, you would have more lenders that are in play. I would say, as Jose can attest to, doing a fully merchant battery storage deal is definitely not for the faint of heart. And so the challenges there really require people to really get in the weeds on what the forecast numbers look like, and what areas, what kind of costs are associated with building the projects. And a lot of times these projects are built using energy arb. So you really are focused on the volatility of power prices in certain regions, and that's why I think a lot of these are being built mainly in Texas, to some extent in California, but I think that's where these are the target areas, especially with West Texas. You have a lot of intermittency with the build out in wind as well as solar. So there's a tremendous amount of volatility that can be captured. But definitely these financings are not for the faint of heart. I mean, you really have to understand what you're getting yourself involved in. And it's ironic because a lot of developers would tell you that they don't want to have contracts because, we've seen the flip side of it where you have contracts that, cause you to force you to deliver in certain instances where there's congestion issues, and that actually causes a mismatch in the revenue stack as well. So there's this like push and pull where you have people that want to do fully merchant storage facilities, and to finance that is really very limited. But then you have the fully contracted deals that are probably won't capture much of the volatility, and thus you create a situation where a lot of people would jump on the financings, but you also don't really have as many developers interested in wanting to build that.
Great. Well, thank you, Andrew. Ken, Jose, do you want to address any other challenges that you find that you would like to highlight? Okay, great. Well, moving on to a second question. This one is for Jose. So for you, Jose, what are the most effective financing structures for energy storage projects in the US, and how have these structures evolved over time?
I think what we are seeing, and to Kelly's point, it's definitely the reason you have much more advanced or developed markets in California and Texas is that revenue stack. So having those options of different revenue streams is very important from a financing perspective. There is, like Andrew just mentioned, a trend to try to take advantage of that volatility. So you are leaving a lot of money on the table by going contracted. So the big challenge is finding that structure where there's sufficient, for the most part, and like Andrew mentioned, we are getting comfortable with the fully merchant deals, which of course that has a big footnote there with quite a few things that will be incorporated in the structure, such as cash sweeps, higher DSCRs, et cetera. So it's not a plain vanilla transaction when you do a fully merchant deal. There's a lot of things to be considered, but finding that mix or that right balance between contracted and non-contracted revenues might be key for all of these projects nowadays, so that you can hit both, the risk appetite of the different investors, at the same time hit the returns that you're expecting. One thing I would also like to highlight is that as more and more of these projects come online, if you look at the forecasts and depending on, on each of the forecasts views on how many projects will be able to actually get online because of these supply chain issues that we've been talking about. But the total revenue that you can capture with a project declines significantly as more projects come into the grid and they're placed online, because then there's more players taking that volatility, and they're flattening that curve, that volatility, and as such there's less and less opportunities to take advantage of those. So I think really there's a lot of financiers out there that are willing to play around with the structures. I mean, you will have different structures depending on the market, depending on the type of project. These will continue to be lithium-ion technologies. I think there's a couple of questions on the chat, so I just wanted to highlight there is a Q&A separate box. So if you guys can put the questions in that box, we'll be able to see them more clearly. But yeah, so I think overall that's how I would look at just the structuring overall. I know it's a broad answer, but I do think that there is a lot of flexibility, and the lenders out there are willing to specifically look at a project and make it work. But the challenge is finding that balance where everybody feels comfortable with the project's characteristics.
Okay, perfect. Well, thank you, Jose. Next question. So we're talking a lot about California, Texas. What other markets are really, really hot right now in the energy storage projects? Ken, do you have any specific market that you find interesting to invest?
Well, we, you know, as a appraisal service provider, you know, we follow where the developers are going. And, you know, obviously the, you know, the hot ones are Texas, was one of the places you can do merchant, which is sort of interesting, you know, coming from the solar world where, you know, there's just not a business model that works for merchant solar, you know. California, otherwise, just because it's, you know, at this point, there's too much generation, you know, there's more solar than you can use at noon, and you essentially need that additional power for when the duck curve ramps up around sunset. You know, so that's certainly two markets that come to mind where the, you know, the fundamentals are pretty strong. And there are now, you know, multiple states with, you know, including New Jersey, where I live, with storage requirements. So, you know, follow the incentives, follow the money.
Hey, thank you, Ken. Anyone else? Kelly, are you going to mute? No, just checking.
All right, so I'm just going to say Arizona, I think, you know, sometimes gets, you know, sort of coupled with California, because we do have CAISO Bucket 1 resources that can be built in Arizona and delivered in California, depending on the line. So Arizona is another key market that I have focused on. I think you got to follow the offshore wind companies also in some cases, because a lot of them are being incented to package or couple energy storage with their onshoring as a way to provide more of a balanced energy flow to their customers. So, you know, while some of those are still nascent, we are seeing development up and down the East Coast, and especially in New York City and the New York area, Long Island, et cetera, Rhode Island, those areas. They were incented in their bid packages actually to couple their projects with energy storage as a way to improve their ranking. So I think that's, you know, that's one of the niche markets that's developed, and we've seen all of those very large European offshore wind companies now get into energy storage. Some of them, Equinor has acquired an energy storage company, and we're seeing a lot more interest in partnering with developers like myself to do these projects to help their projects actually balance as well as arbitrage energy in these markets as a way to improve the profitability of their long-term offshore wind renewable generation.
Perfect. Well, thank you. So we have a question from one of our participants. He doesn't seem to be able to use the Q&A. We're checking that, but in the meantime, I'll go ahead and ask it. Whoever wants to respond, please do. If there was a novel energy storage technology developed, how much cheaper than lithium batteries would it need to be for it to be deemed attractive by investors?
I can take a first try at that one.
Sure.
I think more than the price itself, at least from the different pool of investors that you have, it's really de-risking the technology. So it's really getting projects done. It all comes down to that. So, you know, getting projects done at the beginning will definitely require much more expensive capital, which will be attractive to certain investors. So de-risking the technology from the technology side will be important, but it's mostly so that it gets to a scale where it's really you know, something that we all start talking about. It becomes about deploying those first assets, having a little bit of track record, and getting there is really the challenge. And again, it's probably there's a lot of venture capital out there and a lot of private funds that are investing in these higher risk profile projects. but of course that's gonna impact your own numbers, because the return that those companies or those investors will be expecting will be definitely higher. And once you deploy sufficient assets, you'll be able to access that lower cost of capital resources.
I can kind of take further on that, is that even though costs may come down and maybe you have some sort of game-changing technology that has, a tremendous amount of storage for long-term durations, I think the issue is going to be also who is, excuse me, who the developers of that technology will be, and do they have the wherewithal or the financial capacity to be around for a long-term period to be able to, to backstop any sort of warranties associated with that technology. So, it's not just a cost game, as Jose was talking about, but it's also, is this technology even also achievable? Let's say the cost goes down quite a bit, but if it can't be deployed on like a utility scale basis, then it's a little bit meaningless as well. Like back in the day when people were talking about these biodigesters and all that, where people will say, hey, I got a 5-gallon tank that could produce this stuff, but when you scale it to 100 million gallons, it's much different. So same with battery storage. It's like the technology and the cost might come down quite a bit, and that's what we anticipate going forward. But the financeability is always going to come to, is this accepted technology where an independent engineer will sign off on the technology, and will the company that's backstopping this technology be able to fulfill their warranty obligations?
Yeah, to follow up on Andrew's point, there is the efficiency of the machine itself. When I think of, say, LCOE in generation of the particular generation technology, and then there is project LCOE, and you may have substantially different overhead loads depending on how much infrastructure investment you need for per megawatt of generation capacity, and that may vary considerably at different levels of scale. So just because you have a machine and technology that works best, on a test bench, size, like so many other parts of life, size matters, and how much sort of overhead investment you have to make, and for that matter, which party is making it. Is it all being financed by the project developer, or does the place where you're connecting to the grid pick up some of that cost?
Okay, perfect. Thank you. We have another question from George, which is, how do you expect the IRA to change financing of battery energy storage system projects?
Well, I have a couple of thoughts on that.
I could tell
by
your
face.
Is,
of course, the standalone energy credit. It used to be that you could only get ITC on a battery if it were attached to a solar plant. And, I'd be curious to see the studies on, how many batteries were suboptimally located, because they, really could have done more good to the grid as a whole if they had been where the congestion was, as opposed to where the solar farm was. So now you've got the 30% ITC for standalone storage, regardless of technology, as a matter of fact. And what that will do is essentially pick up a third of the cost, a little less, of an asset with what's the correct technical term for free money. In addition to which, there are adders, 10% for domestic content and 10% for location in a energy community, which is basically a community that's lost job because a coal mine or a gas-fired power plant or something like that has closed down, or it's a place where a brownfield is located. So you can have some fairly significant ITC, which means that you can have a combination of cash equity and tax equity in your capital stack. It generally tends to change the way the debt comes in a little bit, because tax equity investors don't like traditional debt that is senior to them. Hence, it has to be back leverage. But significant chunks of new money can come in, basically give a lot better return on cash equity in these projects than was possible in the past. The only thing you do have to watch out for is because of the labor protective provisions in the IRA coming from the Biden administration, you have to meet the prevailing wage and apprenticeship requirements to build and operate these facilities. And what exactly that means will be coming out in regulations to be issued. But they essentially are responsible for the difference between an ITC, a base level of 6%, and a full credit level of 30%. It's a 5x multiplier. The same is true for the two adders. They can be 10% or 2%, depending on whether you make the prevailing wage and apprenticeship requirements. So that's something that people will be looking at carefully.
I can kind of expand on that as well, is that, with the IRA and the ITC applying to battery storage now, you are getting a lot. We're getting quite a bit of inquiries on financing battery storage, standalone battery storage systems. The issue that we're contending with is, as Jose can attest, when you're financing 100% merchant battery storage, that makes it less appealing for the tax equity investor, as they want contracted assets to be able to have any, to avoid any issues with recapture if they're subjected or beholden to market cash flows. So when you look at that, you're also having a lot of dialogue amongst developers that want to see how financing on the transferability issue is very crucial at the moment. But everyone's at the moment is really waiting for the IRS to give guidance on the transferability rules. As if you start to go down the path of financing and trying to bridge any sort of the transferability rules, you would have to know where the recapture ultimately lies, and that could ultimately impact the buyers of these credits. So there's definitely a bifurcation of where you see the market is excited about it, and you see a lot of inquiries, but you're also seeing very limited amounts of financings getting done at the moment. I think I shared with the group that there was one recently that was I think done by a tax equity investor. I think yesterday it was in the news rags to show that it is getting done. But again, it's going to be a question of where the ultimate rules are going to sift out and how the IRS is going to treat the transferability rules. Otherwise, it could limit the buyers of these credits, and ultimately that would be a large constraining factor for, especially on the lender side, extending any sort of a bridge loan for that.
And then finally, how the insurance market develops, because there will probably be more people who would want to do a direct transfer sale of ITC than will be considered creditworthy enough to be able to live up to their tax indemnity obligations. So you're either looking at balance sheets or insurance, and it will be interesting to see how the insurance market develops in tandem with the regs coming out on the specifics of the mechanics of the transfers.
Okay, thank you. So I see, Jose, that you want to answer a question from Joshua.
No, I was gonna do that directly on the text, but I do wanna add just real quick to what has been said already. I think the IRA, and I think just looking at the list of attendees, I know there's a lot of people that's not here US based, so I just want to backtrack a little bit. So the Inflation Reduction Act has introduced tax credits to or tax benefits to the standalone storage projects. And so there are structures that need to be put in place here in the US so that you can monetize those tax benefits. So it's a very unique structure that's only here in the US market. So actually a lot of the consulting work that we're doing with the financial models, et cetera, is building these structures for companies around the world so that they can understand the impact and how to structure that. So I just kind of wanted to mention that on the kind of the first part. And the second part, like Andrew mentioned, these credits can now be sold. There's a transferability, so you can sell them. So you have an additional revenue stream, potential revenue stream. How much you will be selling them for, it's still unknown because that market has not been created yet, although there's starting to be noise. We were talking about it just before the conference of some projects starting to use this transferability and sell these for some kind of monies. So that's what we're seeing here in the US, and as a result, definitely the structures are either gonna be very much in line with the tax equity structure, having a tax equity partner, which again is something very unique to the US, or considering those additional revenue streams from transferring those credits. And as Ken mentioned, you have to take into account all the rules so that you make sure that you can get those credits.
And I'll add one more thing to that, and this is that size matters a lot for a lot of these traditional tax equity companies that participate in that market. I mean, the larger the project, the more interest you have. You can spend as much time doing tax equity financing on a 10 megawatt battery that you can on a 500 megawatt project. So I would say that most of the traditional investment tax folks that we work with, you know, like the size, you like very large projects, which of course I like to do big projects. Our project out in New York is actually on a brownfield site, the site of the old Paletti plant in Astoria, Queens. And, you know, back to, I think Andrew was the one who mentioned it. I think that a lot of us are waiting for further guidance from the IRS in terms of, you know, how do you actually demonstrate or prove these things, and how can that, you know, pollinate your pro forma in a way that, you know, is secure. So I think there's, while the market was very, very excited to see the standalone ITC come out, and a lot of us were expecting it, we still are, you know, patiently waiting for some additional guidance and direction on that.
One other point on that does get you mentioned that about the size issue with these battery storages. I guess on the transferability front, there's also, you know, the step up in the accounting rules. So if you have a project that's fairly well sized, well, you may have to forego the depreciation benefits with the associated step up if you go with the transferability. So there is some nuances to the financings here. So if you go that route, you may be getting a smaller portion of financing, and that could also impact the economics of the project itself.
Yeah, and speaking of the step up, it's interesting to see how you actually get there, because, for example, there are, you know, two flavors of basis for determining how much ITC a project gets. For something that is self-constructed, i.e. built, owned, and operated by the same company, it goes with a cost basis. If it can go with a fair market value, which may be a higher number if it is attached to a taxable transaction, such as a tax equity flip partnership or a sale leaseback or something like that. And essentially, you will look at the cost and the income approach. Appraisers are always obligated to consider the market approach as well, but in big industrial assets, you really don't have comparable comps. So we stay with cost and income. And to the extent the present value of the project earnings PVs back, you know, at a discount rate of the weighted average cost of capital to a number bigger than the cost, you know, you can justify some step up. What is interesting is, even in putting together a cost basis number, you have to make sure you capture all the soft costs. And, you're allowed to take a developer's profit, safe harbor would be not in excess of 20%, as well as, for example, there's a premium for the fact that it is all in place. Essentially, the whole is worth more than the sum of the parts, because if you were to build it yourself with all the same cost, you would still use the time value during the construction period, the turnkey premium. That was the term I forgot. And it's really the sort of appraiser's judgment as to determines how much of a percentage weighting you put on the cost versus on the income and on the income approach. So there's some art there.
Perfect. Well, thank you everyone for your interventions. The next question comes from YouTube from Chad, and he asked, what is the timeline and likely technologies for 8+ hour energy storage projects? Directly asked Andrew, would you switch to financing techs other than batteries at that point?
I mean, we would consider that, but I mean, if you look at an 8-hour battery, what is the benefit of doing that? I think a lot of where you have battery storage, where it's most effective or most impactful is in the first 1 or 2 hours, where if there's a disruption or something, that it could come to backstop any sort of like gas fire or even a solar or wind or something. When you start getting into long-term storage, I think you start to see where the cost benefits are to that, what kind of contractual you probably be looking for more potentially like long-term contracts where you're able to if something happens to a plant or something, that you can capitalize on some of the costs for maybe major outages or something like that. But otherwise, if the technology does evolve such that there is like not just a cost, but the benefits of having this new technology, and we have it's certified by the engineers, and also have the capacity for the warranties to be satisfied over a long-term duration by the OEM, then I think you would consider all those factors. But otherwise, long-term storage, I guess, would be beneficial if you have like a major, I guess, if there's like a major storm or something that knocks out power for days at a time. But again, if you're talking only about an 8-hour type situation, that's also only gonna be impactful for a small amount of time. You still have to recharge those batteries or recharge the system.
Well, the other end of that consideration is seasonal storage, because I think the Northern Hemisphere gets something like 30% less insolation in the winter than in the summer. So at the end of the day, you either have to sort of overbuild, your solar generation, as an example, for the winter, or you have seasonal storage that basically has one charge discharge cycle a year. It charges on July 4th, discharges on New Year's Eve. And obviously you're in need of a completely different business model to make that one work.
I've seen a lot of interest in long duration storage, and unfortunately that market is still somewhat nascent from a commercial practical standpoint. I would encourage people to look at EPRI's website. That's a research think tank here in the United States. They are really working with a lot of new technologies to help them through the valley of death, which we call it, for them to commercialize and scale up those technologies. The DOE, also the Department of Energy in the United States, has some really, really strong programs to try to jumpstart some of these technologies. And to Ken's point, from a time, and also Andrew, when you look at long duration, you got to look at who is your likely customer. And in some cases, cost doesn't really matter. And in particular, I'm thinking of the military. So the military has very, very important requirements for grid resiliency around their Navy bases or military bases, where they need to have really guaranteed almost 2 weeks of energy. And so that's going to make it very difficult for them to pivot off of natural gas or other fossil fuel type generation to renewables and batteries or storage without having that be available to them. So I think in certain applications, it's going to be a niche market, but it's one of those markets that I think are going to be quickly developing technologies so that that the rest of the industry will benefit from the flow down of that investment in these technologies. So DOE, EPRI, very, very good resources for people interested in looking at where are these technologies coming from, what kind of technologies are they, and where are they in the commercialization pathway.
Yeah, a lot of that is something that in a different era might have been picked up by the big hydro dams, but frankly, the Colorado River has picked a poor time to evaporate.
And just to finalize the thoughts, I think, I see it as a kind of a different stages of where we'll be. So I think we're at the stage where we're only getting comfortable with short duration. And until we all get fully comfortable with short duration, long duration might be the next conversation that we all really sit and have. But for now, I think we need to get comfortable with the I would say I wouldn't say easier, but just with that piece first, and then we'll get to that point. How long it will take, we don't really know. But for now, I think there's still enough unknowns on the shorter duration technologies to where we're trying to figure those first rather than thinking more into the long-term ones.
Perfect. Well, thank you all for your insights. Next question. Kelly, this one's for you, but please, the rest of you chime in if you want. How do interconnection costs impact how these projects pencil out? Have heard these costs have been high in New York. Would love to hear everyone's thoughts.
That's an excellent question, something I didn't even touch on yet, but we can't really have this discussion without talking about interconnection queue. So interconnection queue, we can talk specifically if the question's about New York City. We have a very congested queue. In my opinion, you have a lot of opportunistic developers that get queue positions because it's very inexpensive, and then they hold on to them through a period of time, hoping that they're going to be able to flip those queue positions. The way the queue positions work is that you basically get in line, you tell the ISO authority that you want to inject at a particular location. Let's just, for example, 100 megawatts, let's say. You want to inject at a certain substation. So there's really two significant costs related to that the developer is asked to take on. And those costs are developed over what's called a facility study period, where the developer continues to make investment in that queue position that can be hundreds of thousands of dollars. And at such point, then you get the NISO, in this case, would come back and say, your substation improvement's going to be 13.5 million, 15 million, 20 million, whatever that number is, for you to be able to inject at that place just for that substation. And then you're going to have system-wide impacts that may or may not be borne by the utility or the power authority there. So you really, from a development standpoint, you really have to have a good feel for what the injection capacity availability is at each of these key nodes that you want to inject at. And those numbers need to be factored into, the marketability of your energy from that location. It is a super important criteria. It is always the first thing that I look at is proximity to substation and what's the injection capacity available at that location. And then in New York, it's particularly difficult because we are dealing with extremely high property values. I like to do locations that are waterborne from a fire department standpoint. I know all of the big substations that have injection capacity availability, and tying those two together can get very expensive. So getting back to what I started with, advantages in the market, it's going to advantage companies that have deep pockets and can stay in that development game through these 2 or 3 years when you're going through the facility study, that at the end of the time, you can say, can my project bear a $15 million, $20 million hit for substation improvements for me to be able to inject at that location? And that's just another cost of doing business that needs to be factored into what's your lease, your purchase price of the property, what's your equipment cost, how has that risk of lithium changed over those last 3 years while you've been waiting for that facility study? I think I will say one thing, it's not to that point, but it's really important. The ISOs really need to take a look at these queues, because in California in particular, I mean, there is so much queue congestion, and a lot of these queue positions aren't real, because I know all these substations, and so a developer came in 3 years ago and said, I want 1,000 megawatts. There's no property that's within close proximity to those substations that can support, a 10, 20 acre energy storage project in the middle of a very urban market. And yet those queue positions, I think, are making a lot of the regulators that have climate change goals have a sense of satisfaction that the market is going to meet those goals because of looking at those queue positions. So there's a little bit of a disconnect, I think, in both New York and California in terms of what are real projects in those queue positions and what are those queue positions should fall out and come up with a more reasonable, practical estimate of what is in that pipeline and it's going to get built.
Thank you, Kelly, for that explanation. So next question from Saeed is, can you provide a few insights into predicting revenues from the sale of the discharged electricity in a merchant model?
I can jump on that one again.
Okay.
Just because of looking at all these merchant deals, there's way too many variables, and actually a lot of the forecasters out there have proprietary software, so it becomes kind of a black box on how you're getting those numbers. I've seen projects that are substantially different within the same project, but from different vendors. The interesting thing about those is that at the end of the day, no matter from where the revenue stack's coming from, they kind of have a ballpark number that is not too far off. But I would say that there are options out there in the market. There's hedging mechanisms, there's hedging products, so that there are ways to de-risk that merchant exposure. And in addition to that, again, higher debt service coverage ratios from the lenders, et cetera, et cetera. But it really, there's historical data that you can get into and kind of try to follow. There's definitely some, forecasters out there that are much more aggressive than others. So it's really hard to pinpoint how to get this. But at the end of the day, I think there is sufficient workarounds in terms of how you structure a deal within, clauses within the financial agreements, et cetera, to where you can really, regardless of if the merchant price is expected to be 30 or 40, there's enough mechanisms there to get everybody comfortable to a certain degree. But again, like I mentioned before, the key and the challenge is finding that right balance.
Kind of to further along that thought, yeah, I don't know if there's a magic a bullet here for predicting revenues. Otherwise, if that were the case, none of us would be doing what we're doing right now. A lot of what we see, and like as Jose could attest to, the models that we see, the forecasts are all based on a lot of historical averages. But then if you look at, battery storage in the early stages, many of these systems were built, especially here in Texas, on the basis that it's right way risk in the summertime. If it's in the heat of the day, you're going to see spikes. But then, we had the winter storm here a few years ago, and then we had a spike in the wintertime, and then that really caused some significant disruption. So there's really no way to really fully predict what the revenue stream is. And that's why I think Jose's point was the structural elements that we put into each financing. For instance, additional amounts of equity would be involved here, or we would require some sort of equity upside sharing in the form of sweeps. So those are kind of the protection mechanisms that as lenders we would look for to be able to structure these merchant battery storage type transactions. But yeah, there's really no way to predict. I mean, I could put a dartboard up and just like throw a dart and say, okay, the power price today is going to be that. So.
I
Yeah,
love what Jose, oh, sorry, Ken.
No, that's okay. Please go, Kelly.
I love what Jose said because it is absolutely true. I mean, we use 3 or 4 companies that are very, very specialized and granular in the forecasting, and none of them agree. And you typically look at a conservative, you look at a bullish, you look at sort of the average, and then, you know, you go to other companies. If you are looking at either flipping a project to sell it, or you're looking at financing a project, you better have a pretty good forecast rate if you're doing just capacity sales in a merchant market, because that'll kill you. And that gets back to my earlier comment, which is that these revenue stacks are so important because each of those different resource adequacy, spinning reserves, resiliency, on top of the wholesale power, that's what really gets you a type of project that Andrew's going to be really interested in financing, because each of those are separate and each of those have a little bit of risk, but taken together, they really de-risk the project. In particular, if you can get a good resource adequacy price from a community choice aggregator in California, and then on top of that, you can arbitrage that merchant at a good node. Now that's a project Andrew wants to do. But in a lot of the states, why we keep only talking about California and Texas, it's because the ISOs have not put those benefit reward valuations in the way that they're evaluating batteries in these markets. And as soon as they do, those will be the next hot states, because those are the markets that we're interested in developing in.
Yeah, and in our view of the world and looking at a project, I had spoken earlier about, you know, how do we do weighting of the cost versus income approach? You know, a long-term PPA type capacity offtake agreement is something you can take to the bank, and that will be something, well, depending on the creditworthiness of the payer, but that certainly will make us feel better about loading up the income approach, you know, as opposed to stressing the cost approach when it would be nice to see. But, you know, some of these disagreeing experts on, you know, power projections, and, you know, we don't consider ourselves to be experts. That's where we will rely on the experts, do kind of, you know, remind me of the infrastructure in the infrastructure world of all the traffic projections underlying these toll road deals some years ago. As I think it was either H.L. Mencken or Mark Twain said that, you know, predictions are difficult to make, especially with regard to the future. And we got to agree.
All right. Well, thank you. Thank you, Ken. That's a great quote to end this this webinar, actually. So I wanted to thank you, everyone, for being today in this panel. Thank you so much to our speakers. Has been super insightful. A lot of information I'm taking for homework to research and learn more about the industry. And all of these amazing speakers will be at our event in Las Vegas on the 18th and 19th of April. So if you have any questions, feel free to let us know. We'll be waiting everyone. We'll be expecting everyone there in Las Vegas to share more interesting insights about tons of topics, among others, financing as well. So thank you so much, everyone. We hope to see you very, very soon in one of our webinars. So take care.